All right, let's talk about the stock market, but forget all the noise, the speculation, and the chaos for a minute. Today, we're building a strategic blueprint, a clear, methodical process for investing, and it all starts with a pretty common question. You know that feeling, right? You look at the market, prices are flashing up and down, the news is screaming about the next big thing or the next big crash. For so many of us, it feels chaotic, intimidating, and let's be honest, a lot like gambling. It feels like you're just placing bets and hoping for the best. But what if that's the wrong way to look at it entirely? Because for the most successful investors out there, it is not a game at all. It's a methodical, repeatable process. They aren't gambling on flashing lights and ticker symbols. They're investing in actual businesses because they understand them. It's all about process, not luck. So how do we build that process? Well, to guide us, we're going to lean on a powerful framework from Pat Dorsey, who used to be Morningstar's director of stock analysis. Think of these 5 rules as our blueprint for success, a way to turn that market madness into a clear, repeatable method. And here they are, the 5 core pillars we're going to build on. Do your homework, find companies with economic moats, make sure you have a margin of safety, hold on for the long haul, and know when it's time to sell. This is the roadmap that shifts your thinking from being a gambler to being a disciplined business owner. So let's start at the very beginning. Okay, so the first 2 rules are really about one thing, and one thing only: identifying great businesses. This is the foundation of everything. Before you even glance at a stock price, you have to understand exactly what it is you're buying. And let's be real for a second. This table kind of shows the tough spot most of us are in. As individual or retail investors, the deck can feel a little stacked against us. The pros have more time, more training, and way more resources. And that is exactly why having a simple, powerful framework isn't just nice to have, it's absolutely essential. So what does doing your homework actually mean? It doesn't mean you need a PhD in finance to build these crazy complex spreadsheets. It starts with asking really simple, fundamental questions. What does this company actually sell? Who buys it and why? And this all leads to the most important question of all. Is this business protected from its competition? That protection, that durable competitive advantage, is what investors call an economic moat. Okay, so you've done the work, you've found a fantastic business with a wide, deep moat. Awesome. But, and this is a huge but, even the best company on earth can be a terrible investment if you pay too much for it. This brings us right to rule number 3. To really get this, we have to separate 2 critical ideas. First, there's a company's true value, or what some call its intrinsic value. Think of this as what the business is actually worth. It's pretty stable. Then you have the market value. That's the stock price you see flashing on your screen, and it is anything but stable. It's volatile because it's driven by human emotion, fear, and greed. And this is where it gets really interesting, because this is where opportunities are born. In a bull market, when everyone's optimistic, that positive sentiment can push the market price way, way above the company's true value. But in a bear market, fear takes over, and that fear can drag the market price far below its true value. That gap is everything for a disciplined investor. And this perfectly sets up maybe the most famous quote in all of investing. It is the absolute essence of rule number 3, have a margin of safety. The goal is to buy that great business when everyone else is fearful, because that's when you'll find a huge gap between its low market price and its much higher true value. That gap, that's your margin of safety. So you've done the research, found a great company, and bought it at a good price. The hard part's over, right? Well, not quite. Now comes what might be the hardest part of all, the psychology. The final 2 rules are all about patience and knowing when to act, and more importantly, when not to. Think about it. Great businesses don't become great overnight. They grow their earnings, they strengthen their moats, and their true value increases. But that whole process, it takes time. And what is the market's job every single day? It's to test your patience, to try and shake you out of a great position with all of its short-term noise. So if you're holding on for the long term, how do you actually know when it's finally time to sell? The legendary investor Peter Lynch gave us the perfect metaphor, and it's the key to our final rule. So what's he talking about? Cutting your weeds is simple. You sell when your original reason for buying the company is broken. Maybe its competitive advantage is crumbling, or the business is just getting worse. You get rid of those. But here is the classic mistake that so many of us make. selling a truly great company just because the price went up a little and you want to lock in a small profit. That's not being smart, that's cutting your flowers just before they have a chance to really bloom. Your job is to water your flowers and let your winners run. Okay, let's pull all of these threads together now. When you follow these 5 rules, something fundamental starts to shift in your mindset. You stop acting like a gambler who's just betting on tickers, and you start thinking like an owner who is investing in actual businesses. And here it is, the blueprint in its entirety. Number 1, research the business. 2, find its moat. 3, buy it with a margin of safety. 4, hold on with patience. And 5, sell with discipline. It really is a simple, powerful, and actionable framework that gives you a clear path right through the chaos of the market. And that just leaves us with one final thought to chew on. The market is always going to be volatile, it's always going to be unpredictable. But with a disciplined blueprint like this, maybe the biggest challenge isn't outsmarting the market at all. Maybe, just maybe, it's mastering the emotions of the person staring back at you in the mirror.